You're listening to the Valley Current.
Imagine taking the entire gross domestic product of Germany, right?
Yeah.
Like every car manufactured, every loaf of bread baked, every single service in Europe's largest economy over a whole year.
Right.
And then just dropping all of it onto the public stock market all at once. I mean, that is the financial equivalent of what we're staring down right now. We aren't talking about a market trend here. It's a localized financial singularity.
It really is. It's an unprecedented concentration of capital. We have this really comprehensive briefing from Jack Russo. He's the managing partner at Computer Law Group LLP.
Yeah, the CLG $1 trillion IPOs 2026 newsletter.
Exactly. And the central thesis we're dissecting today is whether the public markets possess the sheer, mechanical capacity to absorb multiple trillion-dollar IPOs in a single calendar year, specifically, this year, 2026.
And the reason we're doing this deep dive for you, the listener, is because this isn't some abstract Wall Street thought experiment. 3 of the most valuable private companies in human history, SpaceX, Anthropic, and OpenAI, are all sprinting toward the exit at the exact same moment.
Yep. All at once.
Okay, let's unpack this. If you combine the target valuations of these 3 entities, you're looking at adding nearly $4 trillion in market value to the public exchanges in a matter of months.
It's staggering.
Trillion dollars. I mean, the scale breaks historical precedent so completely that traditional financial models are practically melting down just trying to process it.
Which is why our methodology today has to be, surgical. We are not here to sell you on the utopian vision of artificial intelligence, and we're definitely not here to stoke fear about an impending market collapse.
Right, no doom-mongering.
Exactly. The source material lays out highly calibrated odds. It presents the bullish upside right alongside the bearish structural risks. Our objective is to translate those mechanics so you can, look past the hype cycle and understand what this impending wave of capital means for the broader economy.
And by extension, your own portfolio. So let's start with the physical reality of the company standing at the starting line. Let's look at the valuations and what's actually holding those numbers up.
Makes sense. Let's start with the furthest along.
Right. SpaceX. They are dictating their own terms in a way that feels almost, arrogant. They've set a fixed price of $135 a share for a $75 billion raise.
Which is huge.
Yeah. It implies a valuation of around $1.77 trillion. That isn't a normal IPO structure, is it?
Not at all. Typically, a company goes on a roadshow, right? They offer a price range, say $40 to $50 a share, just to gauge what institutional investors are actually willing to pay.
To see the appetite.
Exactly. But SpaceX is bypassing that price discovery entirely. They're telling the market, this is the price, take it or leave it. And to put that $75 billion raise in context, the current record for the largest IPO in global history belongs to Saudi Aramco.
The state-owned oil conglomerate.
Right. And they raised $25.6 billion in 2019. SpaceX is attempting to pull roughly 3 times that amount of capital from the market.
A private space and telecom company tripling the debut of a nation-state's oil monopoly. It's wild. But what exactly is the market buying for $1.77 trillion? Because my understanding is that it's a very bizarre chimera of a business.
It really is.
It's essentially a wildly profitable internet provider duct taped to a couple of massive money incinerators, right?
That's a highly accurate description of their balance sheet, actually. The CLG briefing breaks this down really clearly. On one side, you have Starlink, their satellite internet constellation.
The cash machine.
Exactly. That is a tangible, highly disruptive telecom business that reportedly generated over $11 billion in 2025. But on the other side, you have Starship, the deep space rocket program, and XAI, their artificial intelligence division.
The moonshots.
Right. Both of those are deep tech moonshots that require staggering amounts of capital expenditure and with no immediate horizon for profitability.
And that extreme blend of steady cash flow and astronomical cash burn is making traditional investors very, very nervous. The briefing points to Steve Eisman. If you've seen the movie The Big Short, you know Eisman is one of the few investors who successfully bet against the 2008 housing market.
A legendary skeptic.
Yeah. And he called this SpaceX valuation kind of crazy, pointing out that it implies close to 100 times sales. Now, for the listener who doesn't spend all day looking at price-to-sales ratios, why is a 100x multiple so terrifying?
Well, to understand why that's alarming, you have to look at how companies are traditionally valued. Normally, you value a mature company based on its profits, like how much actual money is left over after paying the bills.
Makes sense.
But with hypergrowth tech companies that aren't technically profitable yet, investors look at revenue or sales. A healthy, fast-growing software company might trade at, say, 10 or 15 times its annual sales.
Okay, 10 or 15.
Right, so if you're paying 100 times sales, you are mathematically paying for an entire century's worth of their current revenue upfront today. You're betting that their growth won't just continue, but will multiply exponentially for decades without stumbling.
Which is why Eisman warned that at that price, it stops trading on financial fundamentals and becomes a retail cult stock. It basically trades on emotion and the belief in the founder. And the briefing flags another massive complication, the looming threat of a Tesla merger.
Yes, the complexity of that would be a governance nightmare. If SpaceX and Tesla were to merge, you'd be combining a car manufacturer, a battery and energy storage business, a global satellite network, a foundational AI lab, and a Martian colonization effort into a single ticker symbol.
Good luck to the analysts trying to model that.
Exactly. Valuing that entity would be nearly impossible for standard analysts, which just further cements it as a stock driven by narrative rather than math.
Okay, let's pivot to the second contender because they're selling a completely different narrative.
Yeah.
The briefing refers to Anthropic as the cleanest story.
They did, yeah.
They filed a confidential draft S1 on June 1st, 2026. Wait, before we get to the numbers, why is the S1 confidential? Usually when you file to go public, you open the books for everyone to see.
It's a regulatory mechanism. A confidential S1 allows a company to submit their financial documentation to the SEC for review without making it public right away.
So it's like a private audit.
Pretty much. It lets the SEC check their math and ensure they're compliant with accounting standards, but it protects the company's proprietary data from competitors until a few weeks before the actual IPO. They keep their playbook hidden while the referees approve it.
Got it. So behind closed doors, they're sitting on a massive May 2026 funding round that valued them at $965 billion. But the stat that's supposed to justify that valuation is their run rate.
The famous run rate.
Yeah, they reportedly crossed a run rate of $47 billion, up from roughly $9 billion at the end of 2025. That is a vertical climb. But, run rate is a term Silicon Valley loves to use to make things look slightly better than they are. What is the actual mechanic there?
Basically, run rate is extrapolation. If a company makes $4 billion in the month of December, they multiply that by 12 and announce a $48 billion run rate.
Okay.
It assumes that the current month's performance will remain flat or grow for the next 11 months. It's useful for hypergrowth startups, sure, but it's inherently risky because it completely ignores customers who cancel their subscriptions and seasonal variations.
Right. It's the best case scenario projected forward.
Exactly. And the briefing does note that Anthropic's numbers are somewhat flattered by the specific ways they share revenue with their cloud computing partners.
Plus, they have a massive, very weird bill to pay. The briefing highlights a commitment Anthropic made to pay SpaceX's xAI about $1.25 billion a month for compute power.
A month.
Yeah. Elon Musk apparently waived this off as a short-term contract with a 90-day cancellation clause. But, even short-term, $1 billion a month is a severe drain on capital.
It is, though honestly it pales in comparison to the structural commitments of our third contender, OpenAI.
OpenAI, the whale. They filed their own confidential paperwork a week after Anthropic. Back in March 2026, they hit an $852 billion valuation, and they are projecting over $280 billion in revenue by 2030.
Those numbers are astronomical.
They are. But wait, before we go any further, I need to violently course-correct a myth that is driving me insane. If you read the financial press right now, you see this headline repeated endlessly. OpenAI's $852 billion burn rate. I want to be crystal clear here, and the CLG briefing explicitly calls this out. That is completely factually wrong.
It's a massive conflation of two entirely different financial concepts.
Exactly. The $852 billion is their valuation. It's what the market thinks the company is currently worth. It is not their capital expenditure. It's not the amount of cash they're setting on fire every year. Yes, they're spending billions, but they do not have an $852 billion hole in their checking account.
Right.
People are confusing the imaginary price tag of the house with the monthly mortgage payment, and it makes it impossible to have a rational conversation about their actual risk.
Well said. The real risk for OpenAI, as the briefing details, is their web of long-term liabilities. They've signed compute commitments, promises to rent server space, and buy processing power totaling roughly $1.4 trillion spread out over the next 8 years.
1.4 trillion.
Yes. They owe this to Oracle, Microsoft, Amazon, and various chip makers. So they aren't burning $852 billion today, but they have legally bound themselves to find $1.4 trillion over the rest of the decade just to keep the lights on.
And that terrifying math brings us to the absolute core of today's deep dive. If these three companies are worth nearly $4 trillion combined, and they're locking in trillions more in hardware commitments, what exactly is all this money physically building? And how does the math actually work to earn it back?
This is the $2 trillion math problem. And to understand it, we have to look past the software and look at the physical infrastructure. The global artificial intelligence industry is currently building roughly 190 gigawatts of data centers.
Okay, let's translate 190 gigawatts into something tangible, because it sounds kind of abstract. A gigawatt is roughly the capacity of a large nuclear reactor, right?
Yes, exactly. We are talking about building the equivalent power draw of 190 nuclear power plants. These are sprawling, heavily fortified warehouses filled with tens of thousands of specialized microchips that run incredibly hot and require massive amounts of water and electricity just to keep from melting.
And the capital required to build that infrastructure is just staggering.
Beyond staggering. The briefing cites an estimate from Bain & Company that reveals the tree scale of the burden. To justify the cost of those data centers, the global AI industry must find roughly $2 trillion in net new annual revenue by 2030.
Net new, meaning they can't just cannibalize existing software budgets. They literally have to invent $2 trillion of new economic value every single year, starting in just 4 years.
That's the hurdle.
The briefing has a fantastic analogy for this that lays bare how absurd the current situation is. Imagine a town government deciding to borrow billions of dollars to build enough power plants to supply electricity to 10 million people. They pour the concrete, they install the turbines, but right now, only 1 million people actually live in the town.
That alone is a massive speculative risk. But the analogy goes one step deeper. Almost all of those 1 million current residents get their electricity from just 2 local utility companies. And both of those utility companies are currently losing money.
So you're building infrastructure for a population that doesn't exist, reliant on 2 customers who are fundamentally insolvent. Let's bring the actual numbers into that analogy.
Yeah.
Who are those 2 utility companies, and what is the concentration risk?
According to trade publications cited in the report, a staggering 89% of all AI startup revenue currently flows to just 2 entities, OpenAI and Anthropic.
Wait, 89%? That is a terrifying bottleneck. This multi-trillion-dollar global construction project assumes that demand won't just miraculously appear, but that it will rapidly diversify.
Exactly.
But right now, almost 90 cents of every dollar spent on AI is going to 2 companies that are themselves burning venture capital just to stay afloat.
And that bottleneck introduces the most dangerous structural vulnerability in this entire ecosystem. Morgan Stanley has formally flagged this dynamic. It's called circular financing. What's fascinating here is how circular financing creates the illusion of roaring organic growth right up until the exact moment the music stops.
I want to push back on that term a bit because circular financing sounds a lot like a polite Wall Street euphemism for a Ponzi scheme. Are we just talking about a shell game with microchips?
It's not a Ponzi scheme because real, physical, highly valuable assets are being produced and exchanged. But it is an incredibly fragile, closed-loop ecosystem.
Okay, so how do the mechanics work?
Here's the loop. NVIDIA designs and sells the AI chips. NVIDIA also takes its massive profits and invests that capital into new AI startup companies. Those startups then take NVIDIA's investment cash and immediately turn around and use it to buy NVIDIA chips.
Wow. Okay, so NVIDIA is essentially funding its own customers.
Exactly. And the loop gets bigger. The massive cloud providers, Microsoft, Amazon, Google, are investing billions into the giant AI labs like OpenAI and Anthropic.
Right.
What do OpenAI and Anthropic do with that investment? They use it to rent server space on the cloud platforms owned by Microsoft, Amazon, and Google. So Microsoft's massive capital expenditure is simply routed through Anthropic and instantly returns as Microsoft's record-breaking cloud revenue.
So everyone is reporting incredible quarterly growth, but the money is just moving in a circle. I give you $1 billion, you buy $1 billion of my services, my stock goes up, so I raise more money to give you another $1 billion. How does a loop like that actually break?
It breaks when one entity decides to cap their spending. And the briefing highlights a real-time tremor in this foundation. Recently, Microsoft's AI chief explicitly signaled an intent to cut their spending with Anthropic.
Oh, wow.
Yeah. If Microsoft cuts Anthropic's budget, Anthropic doesn't need to rent as much server space, which means Microsoft's cloud division sees a drop in revenue. That means Microsoft buys fewer chips from NVIDIA. NVIDIA's revenue drops, which contracts the capital they have available to invest in the next wave of startups. The entire ecosystem decelerates simultaneously.
If the math is this daunting, if we're staring at a $2 trillion revenue gap, an 89% concentration bottleneck, and a circular financing loop that could unwind at any moment, why on earth are the smartest banks in the world fighting to underwrite these IPOs? There has to be a rational counterargument.
There is, and it's vital to understand it. The source material is adamant that we can't just pick a winner between the optimists and the skeptics. We have to look at the objective reality supporting both the bull case and the bear case.
Let's start with the bulls. Why are brilliant, well-capitalized people betting everything on this?
Well, first, the bulls point to the speed of the revenue. Yes, the accounting is a bit circular, but Anthropic didn't go from a $9 billion run rate to a $47 billion run rate just by moving venture capital around. Massive Fortune 500 companies are genuinely pulling out their credit cards and embedding these models into their workflows.
Exactly. The second bullish argument is that we are looking at generational companies. The bulls argue this is a fundamental platform shift, akin to the invention of the railroad, the microprocessor, or the internet.
That's the narrative, yeah.
And historically, if you can own a piece of the monopolistic leader of a new technological paradigm, the long-term returns dwarf the short-term volatility.
And there's a third point here that I found really compelling, specifically regarding the macroeconomic risk. The International Monetary Fund looked at this massive bubble and basically said, yes, it's frothy, but it's not a systemic threat to the global economy.
Wait, really? How does the IMF justify that? Because a multi-trillion-dollar collapse sounds pretty systemic to me.
The distinction lies in the balance sheets. The IMF is drawing a direct contrast to the Great Recession of 2008. That crisis was systemic because the bubble was built on fragile household debt. You had people with no jobs and no income holding highly leveraged, adjustable rate mortgages.
And when they defaulted, the banks collapsed.
Today, the entities pouring money into this AI build-out are Microsoft, Alphabet, Meta, Amazon, and Apple. These companies are sitting on mountains of cash that rival the GDP of medium-sized nations. If the AI bubble pops, these tech giants take a massive loss and their stock prices fall, but they don't drag the global banking system into insolvency with them. They're spending money they actually possess.
That makes sense. And finally, the bulls point to real, tangible productivity gains. If an AI coding assistant can make a team of software engineers even 20% more efficient, a corporation will gladly pay hundreds of millions of dollars for that software because it saves them billions in payroll.
Exactly. The ROI is theoretically there.
That kind of enterprise demand could, in theory, scale up to meet the $2 trillion required revenue. But the bear case is standing right there with equally hard facts.
The bear case hinges on the harsh reality of capital expenditure wildly outstripping current revenue. We discussed that $2 trillion gap. The bears also focus obsessively on concentration risk. Let me give you a statistic from the briefing that illustrates how precarious this is. 61% of NVIDIA's revenue comes from just 4 customers.
Wait, 51%. A multi-trillion-dollar hardware titan, the most valuable company in the world at times, relies on 4 individual corporate accounts for over half its income.
Correct. And if just one of those 4 customers decides they've purchased enough data center capacity for the next 24 months, the ripple effect on NVIDIA's stock and the entire AI ecosystem would be violent.
That's terrifying.
Furthermore, the bears point out the valuations are historically alarming. Central banks, including the Bank of England, have explicitly warned that current tech sector valuations rival the peaks seen just before the 1999 dot-com crash.
And the bears are seeing early signs of demand softening too. As enterprise customers shift from just playing around with AI pilots to actually integrating usage-based billing, the CFOs are stepping in.
The adults in the room.
Exactly. The briefing notes that companies like Uber are starting to cap their AI spend. They're looking at the monthly bills and asking for hard proof of return on investment. If corporate America balks at the price, those 190 gigawatts of data centers become ghost towns.
So the CLG briefing synthesizes these competing realities into calibrated odds. These aren't absolute predictions, but probability matrices. First, what are the odds that all three of these massive IPOs actually price and hit the market in 2026? They put that at 70%. The banking infrastructure wants the fees, and the companies need the liquidity.
Okay. Second question, what are the odds of a meaningful AI valuation correction by the end of 2027? They assign that a 45% probability, so essentially a coin flip.
Right.
That correction would likely trigger if the first few public earnings reports from these companies show that revenue is stalling while costs continue to climb.
And the third scenario, the severe one. What are the odds of a massive 1999-style AI bust by 2029? The briefing estimates that at 20 to 25%, a 1 in 4 chance that the circular financing unwinds rapidly and violently.
So what does this all mean for you, the listener? It means a 45% chance of a correction shouldn't make you liquidate your entire portfolio and hide cash in your mattress. But a 25% chance of a generational bust means you absolutely cannot just put your investments on autopilot and assume tech stocks only go up.
And to truly grasp what a 25% risk of a bust entails, we have to look at the historical parallels. The source material draws specific attention to two massive dates in financial history, 1999 and 1929. The patterns of past euphorias can teach us how this specific structure might fail.
Let's start with 1999 and the dot-com boom. A lot of our listeners remember this vividly. You had companies going public with literally nothing but a business plan and a .com at the end of their name. Pets.com, Webvan.
Classic examples.
The NASDAQ hit its peak in March 2000, and over the next 2.5 years, it lost 78% of its value. It took 15 years for the tech index to fully recover. The parallel to today is obvious, right? A transformative new internet technology, a flood of venture capital, and valuations based entirely on a hypothetical future.
It is, but the briefing insists on a strict intellectual correction here. We have to separate 1999 from 2008. Pundits often lazily say that the dot-com crash caused the Great Recession. That is completely false.
Right.
The 2008 crisis was a systemic banking failure built on toxic mortgage-backed securities. The 1999 crash was an equity wipeout. It destroyed paper wealth in the stock market, but it didn't freeze global credit markets.
So people lost their retirement savings, but the banks themselves didn't fail because they weren't holding the bad dot-com debt on their own balance sheets.
Exactly. So the lesson of 1999 isn't about economic contagion. It's about the patterns of human psychology. Euphoria, the suspension of traditional valuation metrics, the belief that this time is different. Every financial mania finds its own unique asset class to inflate, but the structural buildup is always identical.
Which brings us to the heavier historical rhyme, 1929. We are rapidly approaching the 100th anniversary of the stock market crash that ignited the Great Depression. When analysts compare today to 1929, they obviously aren't comparing AI software to 1920s manufacturing. They're comparing the underlying architecture of the market itself.
If we connect this to the bigger picture, the warning of 1929 is fundamentally about leverage and concentration. Let's explain leverage first. In 1929, retail investors and institutions were buying stocks on margin, meaning they were borrowing money from their brokers to buy shares.
Risky business.
Very. When the market dipped, the brokers issued margin calls, demanding immediate cash to pay the loans. Investors didn't have the cash, so they were forced to sell their stocks, which drove prices down further, triggering more margin calls in a violent, cascading liquidation.
And today, the leverage isn't necessarily your neighbor buying tech stocks on margin. The leverage is the billions of dollars in private credit and corporate debt being borrowed to physically build the data centers based on the assumption that AI revenue will cover the interest payments.
Precisely.
And the concentration risk. It's arguably worse than 1929. The briefing points out that right now, a handful of mega-cap technology companies make up roughly 40% of the entire S&P 500 index.
40%. I want the listener to really internalize what that means for their own life. If you have a standard 401k retirement account, you likely invest in passive index funds that track the S&P 500. You think you are highly diversified across the 500 largest companies in America.
You think so, yeah.
But because of market capitalization weighting, 40 cents of every dollar you contribute is secretly a massive, highly concentrated bet on the success of just 5 or 6 companies, primarily NVIDIA, Microsoft, Apple, and Alphabet.
So your safe, diversified retirement plan is inextricably bound to the fate of the AI data center build-out.
That is the 1929 rhyme. The danger isn't the technology. The danger is when too much of the global economy's wealth rests on too few tillers, supported by massive amounts of borrowed money. When that structure slips, the fall is precipitous.
But understanding the history is only half the battle. You can memorize the parallels to 1999 and 1929, but on Monday morning, the market still opens and you still have to decide what to do with your money.
Exactly.
How does an investor, whether you're managing your personal IRA or directing a family office, actually survive the next 4 years? The briefing transitions from historical theory into a very practical, chronological roadmap.
It breaks the timeline down into 4 distinct milestones across 2 election cycles, starting with the second half of 2026. This is the IPO window.
The moment the starting gun fires, SpaceX prices its shares, the AI labs clear their SEC reviews, and they hit the public exchanges. The immediate risk here is pure, unadulterated day one euphoria. Retail investors piling in out of FOMO, the fear of missing out. The briefing warns that the float will likely be incredibly thin. Explain the mechanics of a thin float and why it causes so much chaos.
The float is the actual number of shares that are available to be traded by the public on the open market. When a company IPOs, they don't sell 100% of the company. They might only sell 5 or 10% to the public.
Okay.
If global demand to own SpaceX is massive, but only a tiny fraction of the company's shares are actually available to buy, it creates a massive supply and demand imbalance. The price will swing wildly on incredibly low volume.
So for a retail investor, the advice is simple. Do not buy on day one. Respect the cult stock dynamics. If you must participate, size your investment, assuming the stock could crash 50% in a week, purely due to volatility. For venture capital funds holding private shares, this milestone is your exit liquidity sell into the retail euphoria. But that brings us to milestone 2, early 2027. The briefing calls this the show me the money test.
Early 2027 is the true crucible. Mechanically, this is when the 180-day lockup periods expire. When a company goes public, there's a legal mechanism called a lockup period that legally prohibits insiders, the founders, the early employees, the venture capitalists, from selling their shares for usually 6 months.
It prevents them from dumping the stock on day one.
Right, but when that 180-day window expires, a tidal wave of new share supply hits the market.
And crucially, that flood of supply hits at the exact same moment these newly public companies will be releasing their first couple of quarterly earnings reports. The market will finally get to look under the hood. They'll see if the $47 billion run rate actually held up or if the churn was massive. The danger here is a double whammy insiders dumping stock right as weak earnings prove the revenue gap isn't closing.
Because of that risk, the briefing advises institutional investors and family offices to use the lockup expiry as a scheduled window to de-risk, take profits. And more importantly, early 2027 is when you must relentlessly monitor the tripwires.
The structural warning signs. The briefing gives us 3 specific metrics to watch, and none of them are going to be found in mainstream tech blogs.
Yeah.
What is tripwire number 1?
Watch Oracle CDS spreads. A CDS, or credit default swap, is a financial derivative. It's essentially insurance that investors buy to protect themselves in case a company defaults on its corporate debt.
Okay, so like a bet against them paying their bills.
Yes, and Oracle is a major player financing this AI infrastructure. If the cost to buy CDS insurance on Oracle starts spiking, it means the institutional bond market. The smart money believes Oracle's risk of going bankrupt is increasing. That is your canary in the coal mine.
Tripwire 2. Watch for accelerating private credit redemptions. Explain private credit versus traditional banks here.
Well, traditional banks are heavily regulated regarding how much risk they can take. Because the AI build-out is so speculative, much of the debt financing is coming from private credit. Massive pools of capital managed by investment firms.
Right.
If the investors in those private credit funds get nervous and start pulling their money out, redeeming their capital, the private credit firms have to stop making loans. The funding for the data centers evaporates overnight.
And the third tripwire is the most direct. A major customer visibly capping their AI budget. If Uber or a major bank publicly announces, we ran the pilot programs, the AI isn't saving us enough money to justify the cost, we are cutting our spend by 40%, the growth narrative shatters.
If those tripwires trip, you are firmly on the bear path. The strategy is to aggressively cut exposure to tech, raise cash, and extend your downside hedges into 2029.
I have to push back here, though, because I want to know what it looks like if the optimists are actually right. Let's say we hit early 2027, the lockups expire, the earnings come out, and the numbers are spectacular.
Well, let's say they are.
The productivity gains are undeniable. The Fortune 500 is renewing their contracts, and the $2 trillion revenue gap is demonstrably closing. What does the bullpath investor strategy look like?
If the gap is closing, you are watching the birth of the foundational utilities of the 21st century. The strategy shifts entirely. You hold your core positions in these AI monopolies. In fact, you buy more during temporary market dips. The only defensive move you make is maintaining a tail hedge.
Let's define a tail hedge for the listener.
A tail hedge is like buying earthquake insurance for your portfolio. You buy options contracts, specifically deep out-of-the-money put options, that are very cheap because they only pay out if the market crashes violently.
Oh, I see.
It costs a tiny fraction of your portfolio, but if a black swan event happens, the payout protects your wealth. You stay aggressively invested in the growth, but you insure against catastrophe.
Okay, moving forward. Milestone 3 is 2028, the U.S. presidential election. A new administration brings intense regulatory risk. We're talking antitrust investigations into the Microsoft-Anthropic partnerships, sweeping AI safety legislation, or changes to corporate tax rates. The briefing's advice here is simple. Stress test your portfolio for both electoral outcomes now, and do not improvise in the middle of a panic.
Solid advice. And finally, milestone 4, 2029, the centennial test. 100 years after the 1929 crash. By 2029, the runway for projected future growth is entirely gone.
The moment of truth.
Yes. The 190 gigawatts of data centers are fully built and consuming massive amounts of power. Either the $2 trillion in net new revenue has materialized to pay for them, or the system buckles under its own debt.
That roadmap tells us what investors should be doing. But to me, the most fascinating part of this entire analysis is looking at what investors are actually doing right now today. The briefing doesn't just rely on Wall Street analyst surveys. It looks at real money prediction markets.
Platforms like Polymarket and Kalshi. These are decentralized betting markets where traders put actual cash on the line to wager on binary outcomes.
Get in the game.
Exactly. The briefing took a snapshot of these markets on June 8th and 9th of 2026. Because traders lose money if they are wrong, these markets are incredibly efficient at aggregating real market sentiment.
And the bets they're placing tell an incredible story. For instance, the market for Will's SpaceX IPO in 2026 was trading at roughly 99%. Millions of dollars wagered, treating the largest IPO in history as an absolute, undeniable certainty.
And regarding the AI labs, traders priced the odds of Anthropic going public by the end of 2026 at about 90%. But the fascinating relational data point is that the crowd assigned an 83% probability that Anthropic will list before OpenAI.
Oh, wow.
Yeah, the market is actively rewarding Anthropic's cleaner story and clearer path to profitability, assuming they'll win the race to the opening bell.
But the most important revelation from these prediction markets has nothing to do with the IPO dates. It is about how the crowd is parsing risk. The briefing calls this the Great Divergence.
Yes. If you watch cable news, you'd think an AI crash would instantly cause a global recession. But the traders putting real money on the line are aggressively separating AI-specific valuation risk from broad macroeconomic recession risk.
Break those numbers down.
In June 2026, the betting odds of an AI bubble bursting before the end of the year had crept up to roughly 22%. It's a minority probability, but it's steadily rising. However, in the exact same time frame, the odds of the United States entering a broad economic recession fell sharply to roughly 19%.
So the crowd is essentially validating the IMF's thesis. The betting market is saying, yes, we acknowledge tech valuations are stretched, and a 1999-style correction in Silicon Valley is a very real possibility. But because this build-out is funded by the cash reserves of Microsoft and Google, an AI crash won't infect the broader U.S. economy.
They believe the blast radius is entirely contained to tech portfolios.
That is the consensus of the crowd. But the crowd is also pricing in another massive macroeconomic factor that complicates everything: the Federal Reserve. The prediction markets show an 80% probability that the Fed makes 0 interest rate cuts in 2026.
So interest rates stay high and borrowing money remains expensive.
Exactly.
And this raises an important question because the absence of cheap money cuts both ways. On the bullish side, high interest rates act as a natural gravity. It prevents the bubble from inflating even faster because borrowing billions to fund startups is expensive. But on the bearish side, it removes the safety net.
Right. Historically, when the market crashes, the Federal Reserve swoops in, slashes interest rates to 0, and floods the system with cheap money to stabilize asset prices. It's called the Fed put. But if inflation is still sticky, The Fed can't do that.
Precisely. If the $4 trillion AI valuations break and the circular financing unwinds, there is no Fed rescue package coming. For a moment that is so heavily compared to 1999, the lack of a macroeconomic safety net is a structural vulnerability that most retail investors are completely ignoring.
I want to pause, though, because you use the phrase raises an important question, and we really have to apply that to the prediction markets themselves. The briefing includes a very rigorous appendix warning us about the limitations of this data. How much should we actually trust the crowd's wisdom here?
We must trust them cautiously. And the limiting factor is liquidity, the actual amount of money placed on a bet. When a massive macro question like, will the Fed cut rates, has $33 million wagered across thousands of traders, that 80% probability is highly reliable.
It's a lot of data points.
Exactly. It represents the aggregate knowledge of institutions, algorithms, and deep-pocketed analysts. It is a true signal.
But the briefing points out that some of the specific IPO markets, like what exact date will SpaceX price its shares, only had a few $1,000s wagered on them.
And that is where the signal turns into noise. A market with only $14,000 in liquidity can be manipulated by a single, moderately wealthy individual placing a $5,000 bet. It doesn't reflect global consensus, it reflects the whim of a few people. The rule the briefing establishes is strict trust the heavily crowded markets, but raise a highly skeptical eyebrow at the empty ones.
And that brings us to the end of the historical parallels, the roadmaps, and the data. We have to synthesize this. We started this hour by asking a simple question. Can the market actually sustain multiple trillion-dollar IPOs in a single year?
And the answer, strictly regarding the mechanics of the market, is yes. The investment banks, the clearinghouses, the institutional demand, the system can physically process the sheer volume of SpaceX's $75 billion raise and the trillion-dollar listings of the AI labs.
But the IPO is just the starting line. It is just the act of ringing a bell on a balcony. The actual test, the grueling multi-year crucible, is whether the global economy can organically generate the $2 trillion in net new annual revenue required to pay for the 190 gigawatts of data centers being built beneath these companies.
The next 4 years will answer that question. We're standing at a moment of extreme structural vulnerability, financed circularly yet simultaneously witnessing genuine, awe-inspiring technological progress that could redefine human productivity. Both of those realities exist at the exact same moment.
I want to leave you, the listener, with a final thought to mull over, expanding on the sheer scale of the wealth we've discussed today. If these three companies do achieve these multi-trillion-dollar valuations, and they control the fundamental infrastructure of artificial intelligence and global space communications, they will wield financial and technological power that eclipses most sovereign nations.
Without a doubt.
The ultimate question might not be whether the market can sustain their valuations, but whether national governments will be able to regulate or even contain corporate entities that are richer and technologically superior to the states themselves. How does democracy function when the utility companies hold all the leverage?
It is a geopolitical challenge disguised as a financial event.
Led by Jack Russo, Computer Law Group LLP is a bespoke business litigation and founder-friendly boutique law firm with offices and licensed attorneys in Silicon Valley, New York, and Tampa Bay. And you can reach Jack at computerlaw.com and his team at www.computerlaw.com, where the newsletter we refer to is published in detail and readily available commitment-free with no paywalls or other charges.
Tune in next time on The Valley Current.